Internal versus external audit. What's the difference and why it matters? Welcome to the Audit Voice, TAV, where we simplify audit and accounting concepts for students, professionals, and everyone in between. Today, we're diving into one of the most misunderstood topics in the world of audit, the difference between internal and external audit. If you've ever wondered why companies have both, what each audit team does, and how their reports impact decisions, you're in the right place. Let's break it down in plain language, with real-life examples, so you fully understand not just the difference, but what matters most depending on your role, industry, or career goals. 1. Purpose and objective. Let's start with the why. The purpose of internal and external audits is not the same. External audit. External audit aims to provide an independent opinion on whether the company's financial statements are true and fair. Required by law, especially for public or large private companies. The focus is on the past year's financial performance. Conducted once a year, typically at financial year-end. Internal audit. The objectives of internal audit include the following: to improve internal processes, controls, and risk management. It's not focused on financial statements, but rather the systems behind them. Often initiated by management, not regulators. Can happen throughout the year, not just once. Example: external audit might say, these financial statements are materially correct. Internal audit might say, the procurement process is inefficient and prone to fraud. 2. Who performs it? External auditors are independent professionals, usually from Big Four or mid-tier audit firms like PwC, Deloitte, EY, KPMG, BDO, or Grant Thornton. They are hired by shareholders or regulators, not company management. Internal auditors are employees or internal consultants hired by the company itself. They often report to the audit committee or head of risk. Key difference: the external auditor is independent from the company. The internal auditor is embedded within the organization. This is why external auditors must remain objective. They can't offer advice or get involved in management decisions. 3. Scope of work. External audit focuses mainly on the financial records. Includes testing revenue, expenses, assets, liabilities, disclosures. Ensures compliance with accounting standards like IFRS, GAAP. Internal audit has broader and more flexible scope. Can include operational audits, e.g., are we wasting resources? IT audits, e.g., how secure is our data? Compliance audits, e.g., are we following internal policies or industry laws? Investigative audits, e.g., following a suspected fraud. Summary: external audit reveals financial truth. Internal audit reveals operational health. 4. Reporting line and audience. Who sees the report? External audit reports are meant for shareholders, regulators, the public, for listed companies. Their opinion appears in the published annual financial report. Internal audit reports are confidential, shared with management, the board, and the audit committee. Used to make internal improvements. So, while external audit boosts stakeholder confidence, internal audit drives internal efficiency. 5. Legal requirement and regulation. External audit is legally required for public companies, large private entities, NGOs, and banks. Governed by national audit laws, standards, e.g., ISA, and professional bodies. Internal audit is not mandatory, but strongly recommended for corporate governance. Required in financial institutions, listed companies, and government bodies in many countries. You can't avoid external audit if the law says so. But investing in internal audit is a strategic choice, one that reflects mature governance. 6. Tools and techniques used. External auditors rely heavily on materiality thresholds, sampling, substantive testing, analytical procedures, risk-based audit approaches. Internal auditors use control testing, risk assessments, process walkthroughs, root cause analysis, continuous monitoring tools. Difference in mindset. External audit make considerations like, is this number reliable? Well, internal auditors make considerations like, why did this issue happen, and how can we prevent it? 7. Real-life example scenario. Let's say there's a manufacturing company with excessive inventory wastage, poor supplier vetting, an outdated ERP system. The internal auditor will investigate. Why is inventory being wasted? Are there control failures? Can we save costs? The external auditor will check. Are the inventory records accurate? Is the valuation fair? Are the disclosures in the financials correct? Same company, two different lenses. Conclusion: what matters most? So what truly matters? Both audits are important, but they serve different audiences and different goals. Companies that value both enjoy better governance, stronger control environments, and fewer surprises. Understanding the difference is very important. Do you want to investigate and advise, internal audit, or assure and report, external audit? If you found this explanation helpful, please like, comment, and subscribe to the Audit Voice, TAV. We've got more insights coming your way to help you master the world of audit and accounting the smart way.